Hello everybody and welcome to our next practice journal entry video number 4. In this video we are going to be starting our discussion of the adjusting journal entries. So I'm calling this part 1, and as I mentioned in video number 3, we are going to be talking about the two different methods for recording certain types of adjusting journal entries. So in video number 3 we talked about purchasing certain things in advance, or paying cash in advance, receiving cash in advance, and I mentioned that this would tie into video number 4 for this standard method for reporting those prepaid and deferral adjusting entries. So we're going to be covering that, and then video number 5 talks about the alternative method for how to handle those prepaids and deferrals. So for the next couple of videos, I'm still going to remind you of some of the rules for journal entries, and then again, we'll drop that off after a few videos. This is just to repeat it, just to make sure you're solid with those rules, that you have a clear understanding of them before we go too much further. So debits are always going to be on the left side of the journal entry, and they're always going to come first. Credits are always on the right side, and they'll be indented to the right. They'll all come after the debits. You can have a different quantity of debit or credit entries, so you can have 2 debits, 1 credit, 3 credits, 2 debits. That's fine, as long as the dollar amounts for the debits in a journal entry equal the dollar amounts for the credits in total. We'll follow the normal balance reminders as well. For our debit accounts, we have the dead mnemonic. This tells you the 3 different account classifications that have normal debit balances. That would be the expenses, assets, and dividends. Then we have the credit accounts. You can think of that as clerk or Clark, including liabilities, revenues, and common stock. Now that we're starting our discussion of adjusting journal entries specifically, there are a few additional rules we have to discuss. And the first rule is that adjusting entries themselves will never include cash. There will be a related cash entry either before the adjusting entry or after the adjusting entry, but the actual adjusting entry will never include cash. So we're going to see that come out with our adjusting entries. The other thing that will help you out with these adjusting entries is that they're always going to have either a revenue or expense. In other words, they're always going to have an income statement account, and the other piece of the entry has to be a balance sheet account, which would be an asset or a liability. Again, the asset will not be cash. Now, in some cases, you will be increasing both accounts, so maybe you'll increase a revenue and increase an asset, and in other cases you might increase one and decrease the other. So we're going to see there are basically 4 different types of adjusting entries, and we're going to see the classifications in just a bit, but you can see with 4 different accounts, and you have 4 combinations: a revenue asset, revenue liability, expense asset, expense liability. Those are our 4 combinations for our adjusting entries. So the categories of adjusting entries. We have what are known as the accruals. With the accrual adjusting entries, we're saying that the adjusting entry itself happens before the cash transaction. In other words, we have to recognize revenue or expense before the actual cash changes hands. So we have the accrued expense liability, and both of them are being accrued, and we have the accrued revenue asset. So we're going to see those 2 different types of adjusting entries. The opposite type of adjusting entry would be the deferrals or prepaids. In these cases, the cash occurs before the adjusting entry. So the cash payment or cash receipt, that entry occurs before the adjusting entry. And then the adjusting entry itself is to determine how much of that cash transaction can now be recognized as either revenue or expense. So we have the prepaid or deferred expense, and we have the unearned or deferred revenue. Those are the 2 types of adjusting entries there. Now there's another important note that we touched on in video number 3. This is in regards to the 2 different methods for reporting prepaid or deferral adjusting entries. the method that you choose impacts not only the adjusting entry, but also how the original cash entry was set up. Now, just to give you a little bit of information on this, the prepaid entries basically mean that you have some amount of the purchase or the cash receipt, whatever situation you're dealing with, some amount has not yet been recognized as an expense or revenue. So just as an example, if you prepay for supplies, some of them won't be recognized as supplies expense yet because they haven't been used. So that unrecognized amount is being left in the balance sheet as an asset. And again, you could have a different type of transaction as a liability, where you've received cash in advance, but you haven't earned it yet. It hasn't been recognized as revenue, so it's still a liability. So the amount that's not yet recognized as revenue or expense remains in the asset or liability account, with the amount that is to be recognized as revenue or expense being reported in the income statement account, the revenue or expense account. So that's what matters, is that only the unrecognized portion is left as an asset or liability, and only the recognized portion is left as revenue or expense. So the question is, how do you do it? At the end of the period, you just want to make sure they're in the right place. So the question is, do you put them all in the balance sheet account first, the asset or liability, and then at the end of the period, move the amount that's been earned, if it's revenue, or incurred, if it's expense, move that over to that corresponding account? Now, they call that the standard method because in a way it kind of makes more sense. When you first purchase that supply, it's not an expense yet. It's not even been used. It's still in your storeroom. So on day one, it really is an asset. It's hard to argue against that. So reporting it as an asset makes sense. And then at the end of the period, you look back and see how many of those supplies you've used up. The amount you've used gets moved over to the expense. The amount that's left remains as an asset. Now again, the same thing could happen with the unearned revenue, which is a liability. How much have you earned? That becomes revenue. What you have not yet earned remains as a liability. So with method one, that's exactly what that is. You initially report it as an asset or liability, as we did in video number 3, and then in video number 4, we're talking about the actual adjusting entry, moving it to revenue or expense. But there is an alternative method to this, and it's most commonly used in situations where, for example, you don't buy a whole lot of supplies in advance. You expect to use everything up by the end of the period. So what they basically say is, well, let's go ahead and report it all as an expense, or if we think we're going to earn a revenue, report it all as revenue right up front. And then if there happens to be something left that we haven't earned, or an expense we haven't incurred, only then will we move anything back to the asset or liability account. So that's method 2. It's the alternative approach. This video and the previous video number 3 discuss the standard method. Next video number 5 will deal with both sides, both entries related to the alternative method. Now the one thing I want to point out here is that these two different approaches only impact the prepaid or deferred adjusting entries. They do not impact the two accrued entries, the accrued expense or the accrued revenue. So those are going to be the same under either approach. So let's take a look at transaction number 1 of our adjusting entries. This is probably the most common, or one of the most common adjusting entries you're going to deal with. Employees have worked for 12 days of the 14-day pay period by December 31st, with the payday expected to fall on January 9th. So apparently they have a week lag in between the last day of work and the payday, and that's pretty common. In total, the employees combined have earned $15,000 for this work, for this 12 days of work so far. So we want to record the journal entry, the adjusting journal entry, to accrue the salaries expense for this. So this particular journal entry is known as an accrued expense or liability entry. So we're accruing for the payroll. Now, by the way, this is the last video we're going to see the accounting equation slides. From here on out, in the next video on out, we're going to be talking just about the journal entry. Now, you can still do the accounting equation in your mind just to make sure things balance out, but that's not something you would normally do. You would not need to do the accounting equation discussion before you do the journal entry. That's just a kind of introduction to it to help familiarize you with the actual process. So for this particular journal entry, we know we owe them money down the road. We owe them $15,000 on payday, so we're increasing a liability for salaries payable. We also know that we've used up their benefit. We've used up the benefit of their work to help us to generate revenue down, throughout this period. Using up their benefit is an expense. Anytime you use up a benefit, that's an expense. Now, just like before, whenever we have an expense, it's kind of an automatic negative, so we don't necessarily need to put a minus in front of it. It's assumed to be a negative. So we're increasing salaries expense itself, which decreases equity. So we're increasing two accounts here. The salaries expense, the salaries payable. That's the accrual adjusting entry. The accruals, by definition, increase both accounts, the balance sheet and the income statement account. So to increase an expense, we have to use the normal balance of a debit. So we debit salaries expense for $15,000. To increase the liability, we have to use its normal balance, which is a credit. We credit salaries payable for $15,000. Transaction number 2. The company had previously borrowed funds from the bank that required a balloon payment with both principal and interest due in 2 years. Interest for the first year totaled $1,200, even though it would not be due to be paid until next year. Record the entry to accrue for the interest expense for that year. So this is also going to be an accrued expense liability type entry. There are a few different examples of this, but we're accruing interest expense. The whole point here is that even though we haven't paid it, we've used up the benefit of that money that we borrowed. Borrowing money in itself creates this accrual. You record the expense as time passes, even if you don't owe it yet. So, very similar, the accrued expense entry, it always has an increase to a liability. In this case, we're calling it interest payable. And it always has an increase to an expense, in this case, interest expense. So the good news is once you get a pattern down, you'll realize that, hey, we are debiting the expense to increase it. That's its normal balance. We're crediting the interest payable liability to increase that because that's its normal balance. A debit and a credit, the balance out, we're good to go here. Now let's talk about transaction number 3. We're going to flip over to the accrued revenue transaction. On December 29th, the company provided services to a customer on account in the amount of $750. The company has a policy of billing for services on the 15th of each month. Record the journal entry necessary to accrue the revenues for this entry. Now I have the image of a hospital sign here for a reason. This is very common for hospitals and other healthcare facilities to bill at a certain point in the next month. Part of the reason is they have to gather all the information. There's a lot of coding that goes into billing for healthcare facilities, billing the insurance companies, all of that. So this is quite common. In fact, I deal in Medicare audit for a Medicare audit contractor, and we see this with hospitals all the time where they have a policy that they don't bill until a certain week or a certain day of the following month. Now, the fact that they have not billed for the service does not mean they haven't earned it. They've provided the service. That's all that matters. They don't have to actually bill for it to earn it. Eventually they're going to bill for it, but it is recorded as revenue in the period that they've provided the service. That's when they've earned it. So that's where the accrued revenue comes into play. Now, I do want to make a point here is that if they did bill it, let's say they billed it on the 31st, still in this year, the billing itself records this. There would no longer be a reason to do an adjusting entry if they've already billed for the service. It's only when they've provided a service that they've earned the revenue but have not yet billed for it. That's the only time you need this adjusting entry. So with the accrued revenue, we're also accruing an asset, in this case accounts receivable. So we're going to increase accounts receivable to show that we have an asset, we will be receiving something. We're going to increase revenues to show that we've earned it. And again, we're increasing both. The accrual always increases both sides of the transaction. We increase an asset, increase a revenue. You increase an asset with its normal debit balance, you increase the revenue with its normal credit balance. Debit accounts receivable, credit revenues to increase them both for $750. So now we get to transaction number 4. The company bought equipment 3 years ago at the price of $100,000. It is expected to last 10 years and it's going to be used equally over each of those 10 years. This company uses straight line depreciation, which depreciates the exact same amount every year. So we want to record the journal entry for this year's depreciation. This switches us over to the prepaid side of the transactions, the prepaid deferred side of the adjusting entries. We talked about our 2 accruals. Now we're moving over to the deferrals. So this is a prepaid or deferred expense, a very common one anytime you're dealing with long-term assets. Now this one is an odd one. Depreciation itself is a little bit different than any other adjusting entry you're going to see. Because we use a special account instead of an asset, we use a special account called accumulated depreciation. So when you first think about that, the adjusting entry here is to record the depreciation. In other words, how much of the asset's value has been used this period. So you might think, well, hey, let's just decrease the asset because part of it's been used. And that would make sense. But companies and investors and other users, they keep the full value of that asset, or I should say the full cost of that asset on the books, and they never touch it until they get rid of the asset altogether. Instead, they record this decline in value through a special account called accumulated depreciation. It's what's known as a contra asset account. Its whole purpose is to offset the original cost of the asset through a separate account. So we have both of them. We have the asset, and on the balance sheet you're going to say asset less accumulated depreciation. So what happens here is that we increase the accumulated depreciation account, which in turn offsets the value of the asset. So I don't have all the breakdowns here, which is why I'm just calling this a negative $10,000 for the asset, but it's reduced through accumulated depreciation. So overall, this is a decrease to the asset value. On the other side, the use of that asset is an expense, like we talked about in video 3 a little bit. So it's a depreciation expense specifically. We're increasing the expense, which in turn decreases equity. So we have a decrease to assets, a decrease to equity. We're in balance. So the expense is being increased with a debit. That's its normal balance. We debit depreciation expense for $10,000. Now here's where the trick comes in. If we were trying to decrease the asset, we would use the opposite of its normal balance. It has a normal debit balance. We would use a credit to decrease it. But we're using this account called accumulated depreciation. Anytime you see the word contra asset or contra anything, there are contra liabilities, there are contra equity accounts. We'll see all of those in later videos. But contra, for our purpose, means opposite or offset. So a contra asset has a normal credit balance. It has to have the opposite balance of the account that it's a contra to, that way it can offset it. So we're crediting accumulated depreciation, a contra asset account, which it increases the accumulated depreciation, but when it all gets wrapped together on the balance sheet, we're going to see that decreases the asset's net book value. All of that will make sense in a later video. I'm just trying to show you what we're going to debit and credit here. Now we'll move over to an easier one. We have supplies. It's still a prepaid or deferred expense, very similar to our equipment. The big difference is we don't have to worry about a contra account anymore. So we started the year with $1,000 of supplies. We purchased an additional $1,500 worth throughout the year, and we ended the year with $500 in supplies. We want to record the adjusting journal entry necessary to calculate the supplies used for the period. So for this one, when you see it, you're going to have to think about this for a bit. What dollar amount do you want to use? The way to look at this is that we had $1,000, we purchased another $1,500 to give us a total $2,500. If we only have $500 left at the end of the year, we had $2,500 total, we only have $500 left now. Apparently we used $2,000 of those supplies. So that is going to be the dollar amount. Now this, again, assumes that when we first recorded things, they were recorded in the asset, because now we're going to have to take that amount out of the asset and move it over to the expense. So again, this is method number 1. When we get to the next video for method number 2, both of those entries are going to be different. So just keep that in mind. So we have a decrease to supplies, we're using them up, an increase to supplies expense, which in turn decreases equity. So we want to decrease an asset, increase an expense. We increase the expense with its normal balance, the debit. We decrease the asset with the opposite of its normal balance, so that would be a credit. Debit supplies expense for $2,000. Credit supplies asset for $2,000. Now we'll move on to transaction number 6 here. And with this one, we are going to talk about inventory. We started the year with $10,500 of inventory. They purchased $30,000 of inventory throughout the end of the year. We ended up selling $35,000 of inventory, and they ended the year with $5,500. So we want to record the adjusting journal entry necessary to calculate inventory used throughout the period. So in this case, the difference between this one and the last one is they tell us how much we've used. We sold inventory in the amount of $35,000. Now that's not the sales price, that's the actual inventory that we've used up. That's the entry we need. The rest of it, if they didn't give us this, we could have calculated it by saying 30 plus 10,500 is 40,500. If we ended the year with 5,500, then that means we must have used 35,000 up. So that's still a prepaid or deferred expense, and as you can start to see here, the prepaid and deferred expense is going to be your most common journal entry by far, because you have so many different examples of what would be a prepaid or deferred expense. So for our journal entry, we are decreasing inventory, the asset, and we're increasing an expense account known as cost of goods sold. It's a special expense account. It has an odd name to it. Sometimes it's called cost of sales, but in any case, we're increasing that, which of course decreases equity. That's how we're still in balance. So we're decreasing an asset, increasing an expense. Remember, all of the prepaid expenses, they're going to have the same pattern. Increase an expense, decrease an asset. So increase an expense with its normal debit balance, decrease an asset with the opposite of its normal debit balance, so we have to use a credit. We're debiting cost of goods sold for $35,000 to increase it, crediting inventory to decrease it for $35,000. And we have one more prepaid example we'll go through. This is prepaid rent. And again, we're purchasing something in advance of using it. We're purchasing something before we've used it. So we have a cash transaction that happens first, and then later on when we use it, we're going to record the adjusting entry. So we paid $12,000 of rent for the period of July 1st, 2020 through June 30th, 2021. Our adjusting entry is just to reflect the rent used from July through December of 2020. Not the full $12,000, just everything from July through the end of the year. So that's actually 6 months. July through December is 6 months. Again, this is a prepaid or deferred expense entry. 6 months out of the 12 months, that's half of this $12,000 that we need to record as an adjusting entry. Just like the other adjusting entries, it's a prepaid expense. We're trying to decrease an asset, prepaid rent in this case, and we're increasing rent expense, $6,000. So we have to debit rent expense for $6,000 and credit prepaid rent, that asset, for $6,000 to decrease it. And I guess we do have one more adjusting entry, a prepaid deferred expense adjusting entry to talk through. Again, there are many, many examples of prepaid or deferred expenses. You're going to see a wide variety of them. So the company prepaid insurance for the entire year of 2020, and it was $300 per month. By December 31st, they still had 7 months that they had recorded, that had not yet been recorded, but had been used up. So they paid for 12 months, and by the end of December 31st, they had 7 months that had not been recorded. Notice they didn't tell us when exactly this transaction took place, and that's fine. They just tell us we have 7 months that had not been recorded but had been used up. So the adjusting entry, it's still going to be a prepaid or deferred expense adjusting entry. The key thing is it's 7 months at $300 per month, $2,100. We're decreasing prepaid insurance. We're decreasing that asset. We're increasing insurance expense. And just like before, it's going to be a debit to the expense to increase it, a credit to prepaid insurance to decrease that asset, and we're good to go. And finally, we're switching gears and talking about the unearned or deferred revenue. Now, in this case, it's still a prepayment of sorts, but it's a prepayment to us as a company. And I have the example of an airline here because that's one example where it comes up quite a bit. Airline tickets are sold in advance. The airline has received money potentially months before the trip, months before they can record it as revenue. So in this case, they had previously collected $5,000 in advance for services that were to be provided this year. At the end of the year, they had earned $3,000 of that amount. So there's $2,000 that's still left. We want to record the adjusting entry to recognize the revenue for those services that had been provided, the $3,000 that had been actually provided. So this, again, is an unearned or deferred revenue type transaction. With this transaction, it's the $3,000 of money that has now been earned. It was initially reported as unearned revenue, but now we're pulling it out of unearned revenue because it's no longer unearned. It's been earned. We're moving it out of unearned revenue over to revenue. We're decreasing the liability, increasing the revenue. And in this case, to decrease the liability, we have to use the opposite of its normal balance. Its normal balance is a credit. We're using a debit. So we debit unearned revenue to decrease that liability. And to increase the revenue, we have to use the normal credit balance. That'll increase it. So increase the revenue with a credit $3,000. Now again, anytime you've collected something in advance, think about the airline, think about sports tickets. They're bought in advance. Magazine subscriptions. There are plenty of examples out there where the company collects money in advance before they can count it as revenue. They're all going to follow the same pattern. The adjusting entry under method 1 will be to decrease the liability, increase the revenue. And then that's how you record revenue. You recognize the revenue. So just another reminder here that practice for these journal entries is what makes it easier to understand and to continue to repeat down the road. So we will have plenty more of these videos going through different examples, progressively more complex. But for now, we're stuck in the adjusting entries. We're going to talk about those in the next video as well under method number 2. Thank you for your time in this video, and I look forward to talking to you in the next videos.